Hello, I'm Alex Davies, founder of Wealth Club, and today I'm with Oliver Bedford, manager of Hargreave Hale AIM VCT. Hello, Oliver.
Hi, Alex.
First off, can you give viewers just a little bit of information about who Hargreave Hale are and something about yourself?
So Hargreave Hale is or was a vertically integrated sort of stockbroking and fund management house. We were acquired by Canaccord Genuity in September last year, and we recently moved over and joined their team in 41 Lothbury. The fund management team of 16 has moved over as a whole, so it hasn't really changed how we operate the acquisition, except that we obviously get all the benefits of being part of a larger, fully integrated, better supported group, which I think will also provide benefits to our shareholders, maybe not in terms of performance, but certainly in terms of the softer areas of shareholder communication and that kind of area.
And you've merged your two VCTs into one. Why? And you're also raising new money. How much and what are you going to do with it?
So we merged the two VCTs in March March this year. We did it really because the two were very similar. They had the same policy, they had many common investments, same sort of expense profile. So running them parallel was creating additional sort of non-value add work. It seemed logical to merge them, get rid of that and allow us to focus on doing the things which we thought were going to benefit our shareholders. We raised 25 million at the time of the merger. There is some quirks around HMRC's in legislation and how new capital is taken into the portfolio and how it is counted into the investment test. And that meant we wanted to limit the raise to £25 million in the last financial year. We were delighted with the response. And now, into a new financial year, we wanted to come out and give investors, old and new, an opportunity to come and participate in our journey.
A question people often ask me is, why should I invest in an AIM VCT rather than a normal generalist one? What's the advantage of doing it?
So I think it's not really for me to comment on why people should choose one kind of VCT over another. I think that AIM VCTs have done well in recent years. They learned lessons that came out of the last financial crisis, consolidated, and they've matured. So we now run a pretty strong, diversified portfolio, about 90 qualifying investments, about 140 investments in total. It's about 140 million under management in that fund. So we're talking about sort of strength, diversification. The average company is about 250 million market cap, makes about £4 million of profit. So we like to think we're building a strong core portfolio of investment companies, then all the while planting new investments around the fringe, if you like, and hoping that these acorns will one day develop into strong, robust, reliable, cash-generative, profitable businesses.
It's been a very torrid time for AIM in the last few weeks. Isn't it incredibly risky to invest in this area?
The AIM market's not immune to equity risk, even if the trigger is elsewhere. In this case, it's really related to moves in US Treasury yields. Of course, bringing investment into AIM includes additional volatility risk, if you like, over an unlisted company. But actually, the characteristics that define a successful investment, the quality of the management team, the investment opportunity, intellectual property, cash flows, balance sheet, secular growth, these are all dynamics which are common of a private company as much as they are of a public company on AIM, or for that matter, one on the FTSE 100.
So you talked about briefly some of the characteristics there. What type of companies are you looking for? Are there particular sectors?
AIM is a broad church. There is over 1,000 companies, and they come in many different shapes and sizes. And I think experience has taught me really to be very open-minded in how we deploy our capital. I think a good example would be a company like Zoo Digital. Had a sort of difficult backstory, having for many years provided subtitling to DVDs. Now, obviously, that market went into structural decline, which had an impact on its revenues. But they saw an opportunity to become a digital-led service company, and really are now a play on the expansion of over-the-top delivered content. So, with the likes of Netflix emerging, there's been a significant increase in demand for content, but also content in many languages. Historically, a DVD would be translated 6 times, whereas now a production might be translated into 20 different companies. It's an example of being open-minded and seeing what's there and assessing a company on the individual merits rather than going in with any kind of predetermined thought on the investment opportunity.
And what are some of the recent investments you've made?
So Zoo Digital will be one example of a company. I think more recently, we just made a second investment into Korea Medical. Korea Medical has a market cap of about £250 million. They're developing a new advanced endoscopy tool. It's been approved for use in America and in the US. And it's used really for investigation and to remove cancerous or precancerous lesions in the bowel. That is a procedure which can take 2 to 3 hours in a surgery and require several days in hospital. The endoscopy tool would allow that to be delivered as a day treatment as an outpatient to hospital. So we believe that the tool, which is known as a Speedboat RS2, will deliver better patient outcomes. It will reduce patient risk. It'll cut waiting times and will save funding as well to the healthcare services.
And historically, what have been your most successful investments?
So I'm a believer in long-term investment. If you look at companies that have become truly successful, those stories have emerged over a number of years. And what we've seen in the portfolio is our two most successful investments to date, Abcam and Crane, were investments we made in 2005. So it's about being a patient investor, allowing the management team time to deliver on the opportunity, and just the power of compounding. So as they become more successful, they drive better cash flows, and essentially the valuation will move ultimately to reflect that, and over time that becomes quite powerful.
And AIM VCTs, it's not really typically about the exit, but do you get out of businesses? What would make you get out of a particular business?
So as you say, I prefer not to exit a good company. We work hard to find them, and as I just said, significant returns come with time. So why would we exit? Well, we do it for two reasons. One is that the underlying investment thesis starts to deteriorate, something changes. Maybe commercial adoption doesn't happen in the way we anticipated. Perhaps the management team just aren't sufficiently strong. Competition perhaps. Or the other reason is because the stock has performed particularly well. We like to run diversified portfolios, and that means from time to time we need to sell elements of our holding just to make sure we don't go overly overweight with any particular company.
And are you still finding plenty of new opportunities?
So deal flow can be erratic. It's always influenced by market volatility and seasonality. But by and large, we've been pretty consistent in the amount of capital we've deployed. Typically 20 to 25 deals a year. Actually, over the last 3 years, we've deployed increasing amounts of capital, about £13.5 million last year. So one could always do with more deal flow, but it doesn't worry me. I think clearly for UK growth to do well, we need to have some certainty over the legislative outlook, and that's some event risk around that at the moment. But by and large, I don't feel that the companies that we're seeing, which are looking to deliver long-term structural growth, I don't think that's hugely a risk unless we have a major catastrophe in the way that we leave the European Union or some other event risk materialises.
I'm already in your VCT. I'd probably put some more in this year, but why should I?
So I think the Hargreave Hale fund management team has been together a long time. I think it's probably fairly unique. It's a big team of 16, biggest in the market, we suspect. Managed about £6 billion. So we've got real reach into the market. That helps in many ways. I think it helps us provide a range of funding solutions to companies that we can back them over just about every part of their life cycle. Maybe not seed capital, but from early stage growth capital, particularly now that we're increasingly looking at private companies as an obvious adjacent market for us to move into. So we've been doing it a long time, and I like to think that the team has developed a good track record delivering strong long and medium term investment. I'm not going to say that we're better than any other kind of manager. We have a particular way of doing things that's focused on diversification and long-term commitment. I think that the evidence in terms of Giles's performance over the last 20 years speaks volumes about the style. It's not, the diversified approach doesn't necessarily, it's not easily understood by many people. But actually the evidence is it works pretty well. It requires people to make long-term commitments. They need to be aware of the risk that comes with investing in a VCT. But if they can accept that and they're prepared to commit capital for 5 years or more, then I think the AIM VCT has a good case.
Oliver Bedford, manager of the Hargreave Hale AIM VCT, thank you very much.
Thank you, Alex.